Businesses are rethinking how and where their employees work. Many companies deciding not to re-sign leases in favor of keeping their workers at home. ExxonMobil might be joining them. There's a report in the Journal today that the oil giant is considering leasing or selling its unused office space in Houston. The company reporting that only a fraction of its, less than half of the available office space that it has on its Houston campus is being used. For more on this and what this means for the commercial real estate market, we want to bring in John Gates, JLL CEO of America's Markets. John, it's good to see you. Exxon, far from the only company. We also heard Meta making a similar move in Austin earlier this week. Is this consistent with the trends that you're seeing?
Corporate America and probably global corporates still sort of struggle with what return to the office is going to mean on a permanent basis. So we think hybrid work in some form or fashion is here to stay for many companies. And there are some workers that probably would continue to work from home or work remotely much, if not all of the time. Yes, but there is a greater return to office probably than people are aware of right now.
And John, what's the regional story? Where are you seeing the most growth when it comes to the return to office story?
Is definitely, there is a regional story. So in the United States, that would be across the South, the in-migration markets, we call them. But Phoenix is a winner. Metro Dallas is a winner. Austin is a winner. Nashville, Charlotte, Atlanta, certainly South Florida and the Metro Miami area. So it's almost across the board in the larger cities or metro areas across the southern U.S.
John, you mentioned it was a little bit greater than we think. Outside of those top cities, what are we seeing play out in the rest of the country, and what do the vacancy rates look like?
It definitely varies by city, right? So industries and geographies vary, but it is ticking up nationally to very close to 50%, and we're predicting that by the end of the first quarter, could be as high as 60% on an average day. Which is a pretty good metric. Office buildings have never been 100% full, right? People come and go, they travel for business, they have personal lives that they're working with. So, but vacancy rates are higher in those southern cities. And then the other very strong trend we see is what we call a flight to quality. So newer, better space, more amenitized, maybe a better location, closer to public transportation, the space that has a cool factor to it. It's got maybe a good retail amenities in the neighborhood. Those buildings are definitely leasing at a materially higher rate, and they have much greater occupancy than older product does.
And John, what are you seeing in terms of leasing and rental prices? How do they stack up versus pre-pandemic?
Tale of two cities. So if we take the last comments for the newer product, the flight to quality, we're seeing all-time peak rents set in probably 2/3 of the big markets in the United States in the last 12 calendar months, probably even this year. So that's very different than what we're seeing happen with older office buildings where they're struggling to maintain rents as high as they had pre-pandemic. So it's very binary in that regard, I would say.
John, when you take this and also, I guess, combine the fact that we are in a rising rate environment right now, the Fed saying it's going to remain committed to raising rates, that obviously could spell some trouble here for commercial real estate. I'm curious just how this has impacted your investment opportunities, and are you being more conservative given the current macro environment?
You're probably more conservative or more disciplined in your decision making, depending on where you're looking. Interest rates. Commercial office space rely on long-term capital, and often debt is part of the capital structure in those. And so the cost of capital is going up. It's going up for all operating businesses as well. And so you're selective in where you look. We see a slowdown in velocity of both sales of assets right now and commercial mortgages. There's a lot less construction activity in any kind of commercial asset class. And I think that'll continue for a while because, as you know, the Fed has been very clear that they're not done.
And John, is there any sense of when you might see this normalizing at some point?
I would think at the end of the first quarter, maybe. I think business people, whether they're investors or operators in operating businesses, want to see trends. And so inflation's ticked down a little bit. If it clearly to business people is moving downward and the Fed's actions are working, that gives a little more predictability to people. And I think you'll start to see transaction activity increase at that time, whether it's signing commercial leases or selling assets or recapitalizing and refinancing them. So My sense would be that's probably late Q1 or maybe early Q2, but we'll need to continue to watch. There's a lot of inflationary pressure out there still.
And as we look through the supply chain, whether it's things like labor in developing some of these things, as well as some of the construction materials prices, what are some of the headwinds or what are some of the pricing that you're expecting there?
I think labor will be a greater challenge than supply chain disruptions and spikes in materials cost. Much of the supply chain is renormalized. You see container shipments as an example. The cost of container shipments have come back and the demand for materials has slowed. When you move interest rates as much as they have, you see construction activity really slow down. It has a major impact on the single family housing market, as we all know, and mortgages get very, very expensive. So you see a smaller velocity of people moving, and you certainly see a dramatic slowdown in construction starts. We have a lot of we have a labor shortage though in our country and our economy, and I think that continues in non-office working jobs for sure. And we have a lot of stimulus still coming, so I think construction spend will shift to maybe ESG related activities, for example, and that needs work and labor as well. So I think materials will be less of a problem. Supply chains and cost of materials will be less of a problem than availability of labor and probably the cost of labor.
Well, certainly a lot to keep an eye on. We do appreciate you breaking all this down for us, John Gates. Thank you so much. Have a great weekend.
Thank you for having me.
All right, coming up, fans of Weird Al Yankovic